Hello, my name is Orsi, and I'm going to use this work sample I built to show you my approach to financial modeling. So these blue tabs are the blue assumption tabs. They have blue hard-coded assumptions on them. Anywhere where you see blue font or blue tab means assumption, so that makes it really clear what's driving the model. And I always use this annuals, monthly, time series. So this gives you, max flexibility without making the model unintuitive. Basically, you still have the control of dynamic assumptions. For example, in this case, we're assuming that we start with an acquisition cost of $125 per new monthly active user, but as the company scales and grows, that's going to eventually come down to 63, which is pretty normal for apps and subscription businesses and so on. When you choose this 125, it gets spread on the monthly time series across every month of that year, and then we use that in the monthly calculations. Now, calculating things on a monthly basis gives us a lot of nuance and flexibility in the model, but it has the downside of being not very intuitive. It's very hard to see trends on a monthly basis, so having that annual control helps to make the model not overwhelming and easy to follow, and then having these annual summaries makes it really easy to jump in here and see in real time how changes in your assumptions impact the model, because looking at the monthly results is really hard to follow. So I usually break the model up into some form of revenue and direct costs, or revenue and COGS, corporate overhead, equity, and then some miscellaneous assumptions. In this case, this is an application that has like a marketplace component, a subscription component, and a lottery component. And then down here we have two analysis sections, LTV to CAC and float. This is the most customized portion of the model, so for your business this will very likely be completely different, and there's many different ways to do it, and it really depends on both your business model and the way that you're pitching the business. So I try to tell your story the way you're telling it with the financial model. That's my goal. Corporate overhead is pretty similar across models, so we have a list of employees. I had a benefits load, includes taxes, payroll taxes, and benefits, so 20% is pretty normal in the US, and that just gets added in, and then you get to your total payroll, and I have a running headcount function to keep track of how many employees you have as well. And then you have a list of your non-employee related expenses, so just rent and everything that isn't an employee. And then for businesses that are growing a lot and have a longer projection period, I like to add in this dynamic cost section where we just, in the later years when you don't want to list every single expense because you don't know what your expenses will be, we just assume some percent of revenue will be brand marketing, admin, R&D. And it's really easy to customize this. So once we're done, if you just add a row, drag down, and then change things, and then you can just fill these out and it'll flow through the model. And you can see these category codes. This is a drop-down list. You choose. We can customize what the categories are. In this case, it's marketing, G&A, and R&D. And that just consolidates down here into these costs by code, and then these are what flows into the income statement. So all of the line items on the revenue and COGS, corporate overhead, equity, they're all building towards the three balancing financial statements. So the ISBS CF stands for income statement, balance sheet, and statement of cash flows, and that's where all of the assumptions tabs kind of roll up to. This is the model output. This is what the goal of this whole exercise is. So we have all of the revenue and the direct costs as well as the operating costs, those categories that everything is consolidating to, is flowing into the income statement up here. So you can see how you have this hockey stick type thing where we lose a lot of money initially and then end up making a bunch of money. That's pretty typical for technology startups. And then down here we have the balance sheet. In this case, it's pretty straightforward. We do have this weird float item, which comes from customers paying for things up front and then not redeeming them until later. But everything else is pretty straightforward. We have accounts payable. In this case, we don't have any accounts receivable. Most models I build do have that. We have this deferred tax asset, which is a result of making some losses in the first years, and then you use that to offset cash taxes later on. And everything balances, which is the mark of a high-quality financial model. Then down here is the statement of cash flows, where we are reconciling all of those working capital items to get to our cash flow from operations. And then we have some cash coming in from our equity raises, which I will show you now on the equity tab. So I like this tab a lot. I use it in most of my models, unless it's not a factor, but it usually is. If we zero out all of the equity rounds, you can see up here the cash balance is negative. So the model is not adequately financed. We have a low point of 7 million as well as low points in each of the years. So it looks like in 2024 we're going to need to raise at least 3.13 million. So let's do 4 million. So you can see in real time how the cash comes onto the balance sheet and the model becomes more adequately financed. Right now we still have a cash shortfall of 2.6 million in 2025, so we'll have to raise another 3 million. And then we're good. Technically we wouldn't have to raise at all after this. We don't necessarily need to add other raises here. From here, we have a number of things we could do. We could add more costs to justify future raises, or we could just add the raises and say, yeah, we're planning to do those raises, even though the model is showing that we'll be profitable in the later years. We're expecting to have other costs that are unforeseen, So, and in this case, this client asked for a cap table. This is not completely necessary for a three-statement financial model. We only care about cash flow and the balance sheet of the firm at the firm level for financial modeling purposes. But in this case, we did a cap table to show how equity changes with these valuations. So you can see the founders start with 100% and slowly get diluted, as well as the early investors get diluted by the later. Like if we start raising a lot in these later rounds, everyone gets diluted a bunch. Although it's at a really high valuation, so it's not as bad as it would seem if we're raising $1 billion. And this shows the share count. And then once we have the three financial statements modeled, we can do a number of things that I call output tabs. So in this case, we did a valuation. You can see this is a pretty straightforward DCF valuation. For startups, I like to just take that exit value because generally there are no distributions of any type until you exit. So we get this big liquidity event in 2028. We're selling at 1x revenue, so that's $800 million. But for a venture capital type investment, they require returns of 50 to 100%. So we're using a 100% discount rate. That takes that 800 million down to 25 million for our present value. And I added a ton of raises, so that's not going to make sense. Let's get rid of some of these. So now I take out the amount we're planning to raise, and we get to $17 million valuation, which is pretty reasonable for a pre-revenue company, which this was. It's actually on the high side, but that's kind of what you want to show with this. It's like, look, we're raising at 5 million, but look, if you take these pretty conservative assumptions about what our valuation would be in a bull case, like if everything goes our way, then you can see that provides a pretty good return to you at 7 million or 5 million valuation, or whatever the pre-money angel investors are coming in at. And then I demonstrated that over here as well with the IRR and multiple on invested capital. So you can see that when they come in at that higher valuation for the seed investors, they get a much lower return, 8 times versus 25 times for the angels. So this is kind of the selling point for early stage investors. And then also sometimes I'll build a dashboard that has some charts and looks a bit prettier, and it just gives you a broad overview of what's happening in the model. Typically I price my models on an hourly basis, but I like to give my customers some visibility into how much that will cost. That's pretty much a common request across all clients. So what I do is I'll guarantee a set amount of hours for the first draft. So we'll have a call, we'll plan the model, and from there I'll have a pretty good idea of how long it will take me, and we'll just agree to an amount of hours for that first draft, and then after that it'll be hourly. So typically the models take anywhere between 15 to 30 hours depending on the complexity of the model we're planning, and I can get it done in around 2 to 3 business days depending on my capacity at the time. So reach out and let's set up a call to discuss and go from there. Thanks.